There's this massive transfer of wealth happening right now, just beneath the surface of all the daily headlines. And here's the thing, it isn't random. It's not chaos. It's a machine with a blueprint. And by the time we're done here, you're going to understand exactly how to be on the right side of it.
I mean, if you've looked at your portfolio recently, you know the feeling, right? That pit in your stomach, the wild swings. It's up one day, way down the next, and it feels like it's all just reacting to some random headline. But what if I told you that under all that noise, there's actually a clear, predictable pattern playing out?
It all starts right here. Since the end of February, Brent crude oil shot up by a staggering 40%. Now, this isn't just about what you pay at the pump. This is a shockwave that's hitting the entire global economy. And here's the other side of that coin, the direct consequence. The S&P 500 is down about 9% so far this year. See, the volatility you're feeling in your portfolio, it's not random at all. It's a direct echo of that shockwave from oil prices.
So this is the most crucial point to get. None of this is happening by accident. There's a clear string of cause and effect, a blueprint that explains exactly why the markets are doing what they're doing. And once you see that blueprint, a path forward starts to look a whole lot clearer.
All right, so here's how we're going to break this down. First, we'll look at the problem, the Fed's cage. Then we're going to zoom out and see the 100-year pattern. That's going to show us the great wealth transfer as it's happening. And we'll wrap it all up with your roadmap, the patient investor's playbook. Okay, Section 1, the Fed's cage. This is all about how oil, just a single commodity, can basically hold the most powerful economic institution in the world, the Federal Reserve, completely hostage. So think about the Fed, right? Their main tool, their primary way of managing the economy is interest rates. When the economy starts to slow down, they cut rates. That makes money cheaper, which encourages businesses to borrow, to build, to hire. And it stimulates growth. It's been their standard playbook for like a century.
But a huge spike in oil prices, it completely shreds that playbook. It's a shocking connection. The economist James Hamilton found that out of the 11 U.S. recessions since World War II, 10 of them, 10, were preceded by a sharp spike in oil prices, just like the one we're seeing right now.
So here's how the trap works. Oil prices spike. Suddenly, the cost of making or shipping pretty much everything goes up, and you get widespread inflation. Now, normally the Fed would cut rates to help the economy, but they can't. If they pour cheap money on that fire, they risk creating runaway inflation, which absolutely crushes working families. So their main tool is useless. They're stuck in a cage. They can't help. All right, Section 2, the 100-year pattern. This is where we stop listening to all the panicked headlines, and instead, we look at what a century of cold, hard data tells us is probably going to happen next. Just look at the massive difference here. It's profound. The average bear market, the scary part we all fear, it lasts about 9.5 months and leads to a 35% loss. But the average bull market lasts nearly 3 times longer and delivers more than triple the returns, with an average gain of over 100%. The data couldn't be clearer. The upside is so much bigger and lasts so much longer than the downside. Let me put it another way. If you look at the entire market history, all the way back to 1928, stocks have been going up 78% of the time. The scary downturns that get all the news coverage, they actually make up less than a quarter of our market's history. The dice are loaded in favor of the patient investor. So that brings us to Section 3, the great wealth transfer. I mean, if the long-term data is so positive, why do so many people end up losing money? Well, because in a crisis, wealth doesn't just, vanish. It moves. Warren Buffett built an entire fortune on this one core insight. It's captured perfectly here. He understood that market crises don't destroy wealth. They simply transfer it from the emotional people to the disciplined people. And the reason this happens is because of a little psychological trigger called loss aversion. Decades of research have shown that the pain of losing money feels about twice as powerful as the pleasure of gaining that same amount. It's literally hardwired into our biology, and it causes us to make these predictably irrational decisions. We buy high when we're feeling great, and we sell low when we're terrified. And right here, this is the mechanism of the transfer, stripped down to its core. Every single time an investor panic sells their shares at the bottom, someone else is on the other side of that trade, calmly buying them up. One person's panic becomes another person's opportunity. That is the wealth transfer. Okay. So now we understand the trap. We see the historical pattern and we get the psychology. The big question is,
what do we do about it? Well, that brings us to our final section, the patient investor's playbook.
The playbook is really just 3 core actions. First, own the asymmetry. That just means using broad market index funds to let that 78% upward trend do the work for you. Second, build conviction. You got to truly understand what you own so you have the guts to hold on when things get scary. And third, and this is the big one, use fear as fuel. Learn to see widespread panic not as a reason to sell, but as a potential buying signal.
This is your edge. It's not some secret information. Everyone has access to the same data. The edge is having the right framework. You now understand that oil-fed trap. You know the historical odds are stacked in your favor, and you recognize the emotional triggers that cause everyone else to sell at the worst possible time.
Let me just leave you with maybe the most powerful fact of all. In the entire history of the S&P 500, there has never, not once, been a 20-year period where investors lost money. Every single one. Through depressions, wars, oil shocks, patience has been rewarded 100% of the time. So the real question isn't if the market will recover, it's whether you'll be there to profit when it does.